Hey everyone, welcome back to the IT Investor Podcast, where we help tech professionals turn their 9 to 5 income into lasting wealth through real estate. I am Pramod Gudishetty, your host, and with me, as always, is my co pilot on this journey from code to cash flow, Wally Taylor.
Always a pleasure, Pramod. Today's topic is one of my favorites. It's the value add strategy. It's how we take a property from meh to kind of that wow, a transformation of a decent investment into a wealth building machine.
Exactly, Wally. You know, a lot of people in our audience always ask, what kind of real estate should I invest in? And they always mention, I don't have the time to flip houses or build skyscrapers. Value add investing sits right in the middle, steady, data driven, and scalable. So buckle up. This one is going to be full of insight, math, and maybe a little bit of nerd number.
Perfect. Nerd humor. I love it. Yeah. Let's start by defining what value add actually is, right? Value add means buying a property that's not operating at its real potential, right? Maybe it's tired, mismanaged, could be under rented, and then we're going to improve upon it and raise its income or cut expenses. Almost like a business, right? Just making that business operate better by reducing expense or increasing income.
Yeah. So, Wally, in our data world, this is something like refactoring legacy code, which runs but barely, right? I mean, we try to fix the bottlenecks, clean up the script, make it more optimized, efficient, and also use some of the new technologies of the libraries, and suddenly the performance skyrockets, right? That's what we do with the code, and we need to apply the similar analogy with the properties.
Yeah, Pramod, that's a great analogy, right? So you're going to take this business, and when you raise that net operating income, the property's value doesn't just go up a little bit, it compounds because commercial real estate is valued based on the income.
Yes, that's right. Now, we call this as a forced appreciation. And you are not waiting for the market to move. You engineer this increase so that the value of your property goes up.
Yeah, absolutely. Right. So we always hear in real estate, location, location, location. That's still important, but now it's more about the business plan itself, execution, execution, execution.
Yes, and why this strategy works for IT professionals is for us tech folks, this model is like our home turf, right? Where we are able to easily think analytically and we follow structured process and chase optimization relentlessly. A value add deal is just like a data pipeline. Find the bottlenecks, fix them, and boost the performance.
Yeah, absolutely. You A/B test finishes. You could automate reporting, build dashboards for leasing velocity, and our high income B2 jobs give us the stability to invest while we learn.
And the best way for this to get accustomed to this forced appreciation is you can start small as a limited partner in syndication and watch how a professional operator executes this value add playbook. And you can do this all before you even swing a hammer or raise capital yourself.
Pramod, I love that. That's actually exactly what I have done in my past as well. I still do it. I still participate as an LP in some syndications as well as my own projects. But that's the right move, right? You're going to learn passively. And as you grow more and more comfortable watching somebody or a group with more experience, then you level up with your activity.
Yeah, so Wally, let me give you an example of our current property. I know I have shared in the past episodes also, but let me try to reiterate this example. So we do have a 12-unit property near Virginia Beach, which was renting around $800 per unit in 2022. This was the time where we were trying to buy in this property. The interiors at that purchase time were like more like vintage in the 90s with the beach carpets and all that.
And I know that exact color, man. That sounds like my very, very first condo. I think it was built in 86. Beige carpets, the white kind of off color white cabinets in the kitchens there. They're pretty ugly. Surprisingly, there's still quite a bit of those sitting out there and on the market today.
Yeah. I mean, you said it's was ugly, after 10, 20 years, right? But
Yeah.
at that time, it didn't feel like anything.
Sure. Of course. Yeah.
It was, good, actually. But, as time progresses, the design, interiors, everything changes. And
Sure.
somebody said like these interiors change every 10 years. But
Yeah.
anyway, but anyway, let's dig further into this our model example project, which I'm going to talk about it. So, Wally, we actually spent $5,000 on that 12-unit building for each unit to update. And we were doing these updates one at a time as tenants were moving out. Excuse me. And after these renovations, rents quickly rose to $1,000 per unit. Now that's $200 more, right? And if you multiply this for 12 units, increase in revenue we got was almost like about 29,000. This was annually. And we bought this property at a 7% cap rate. And if you do the math, we created about 400K in new value from this execution alone.
That's the secret. It forced appreciation. You didn't pray for the interest rates to drop or hope for some miracle. We used math, planning, and sweat equity to engineer a 400K gain.
Yes. And we did not time the market, Wally. As you can see, it was just improving the asset, rehabbing
Yeah.
it to the current trend, and it took care of itself.
That's awesome. Let's start breaking this down a little bit for the listeners, right? There are kind of different levels of what value add could be. Got light, moderate, and then of course very heavy value add. I mean, each one of these comes with different levels of risk, right? The light value add, pretty simple stuff. Now we're painting the interiors, landscaping, maybe some new lighting, smart thermostats, stuff that's pretty simple and inexpensive to do. Then we have moderate value add. This is where we're going to come in. We're going to do new flooring, new stainless steel appliances, cabinets get replaced. We might actually improve the property, like the common areas by adding things like a dog park or adding a laundry room for, an additional income stream. And then the heavy value add is where we're just going to full renovation, rebrand, or reposition the entire tenant base. And those are usually like pretty high risk projects.
Yeah.
Yeah, you'll notice. I'll go ahead.
Yes.
Yeah.
Yes. And for our example project, we fall into the moderate category where we did new floors, sometimes new appliances because those appliances were very old. And of course, when you go into moderate category, it also includes the light value add, right? Which is the painting and lighting fixtures update and probably some thermostats updates also.
Yeah. So sometimes those little light touches, they're just as simple as rebranding the property, adding some better management, but they can really have a huge impact without some really heavy duty construction headaches.
Yes. Now you would have to keep in mind that the heavier the lift, the bigger the potential. But of course, it also comes with the risk. So you would have to be thorough with your due diligence, market survey, and all that, and apply heavy renovation if you think that's gonna give you your forced appreciation. So it's like refactoring a code base versus rewriting the entire application. In one sprint, we can do light and probably moderate, but not a heavy lift, right? I mean, rewriting the entire app. It's a marathon.
I like that analogy a lot. Yeah, you're right. Light touches, easy to do.
Let's see what the formula the investor should memorize to get this forced appreciation. So the formula for calculating the new value is NOI divided by the cap rate. So if your property earns K in net operating income, which is total income minus expenses, and the cap rate is 7%, then your property is worth K divided by 7%, which is 1.43 million. And now let's say if your NOI increases by K, I mean to say your new NOI is 120K, suddenly it's worth 1.7 million. So that 20K new revenue which you have generated has made you wealthier by 270K on paper instantly.
I love that math, right? It's so simple. And it's leverage. It's not financial engineering, but we're value engineering. Even a $1 rent increase per unit can add thousands in property value across your whole portfolio.
Yeah, that's the power of scaling, right? In multifamily, where you have many units, right? One improvement multiplied across dozens or hundreds of units creates an exponential impact.
Absolutely. Yeah. There's where you can kind of geek out a little bit if you really wanted to for those project managers out there, those folks that like to kind of control what's going on with their business plan. You can use tools like Asana. That's a really familiar tool for us tech folks. Power BI for doing dashboards, even automated email scripts for investor email updates, right?
Yeah. So basically, you can run this real estate like a agile software project with sprints, backlogs, and retrospectives. So basically, you should be diligent and you should have full control of the project, what is happening on it, and you should look ahead for future and plan. So our system uptime is occupancy and our data latency is rent collection speed. And the system downtime is the vacancy, Wally.
Yeah, definitely. Or maybe like a water heater breakage. That's a production outage.
Yes. Okay. Now let's be real and look at what's the risk management. Not every value add story ends in confetti and cash flow. So I'll give you another example, Wally, where this is in St. Louis, where we had to do a roofing project. And this roofing project got delayed by 2 months because of getting the materials, probably due to tariffs or whatnot from the supplier. And during this intermittent time, there was a bad storm and it caused a leak in one of our units. The good thing is, thankfully, that unit was vacant, so no tenant property was damaged, and a roof got collapsed in that unit. Actually, to give you
Wow.
in more detail, and the water from that unit went to the below unit. All in all, it wasn't a big damage. For it costed us about $1,000 to fix this.
Wow, that's not too bad. Just some drywall repair,
Yeah,
pretty much.
yes, drywall repair. Luckily,
That's very fortunate.
yes, yes, and also you should also consider the cost of HVAC replacements when you are buying into the property. Now, the lessons learned is always you need to pad your renovation budget by at least 10 to 15%, and also brace yourself for increase in taxes as the property changes hands.
Yeah, exactly. Treat contingencies like redundancies in cloud systems. You'll thank yourself when those unexpected things happen. Like you mentioned, HVAC, you can even plan ahead. I had a property where we bought the HVAC unit. We knew a replacement was coming soon. So we actually bought the HVAC in the wintertime when they're actually much cheaper because the demand is lower. And then the installation still cost us, about the same for the labor. But we actually bought a unit that was like last year's model and saved a bunch of money. Those HVACs are, you know, close to $10,000 for some of the larger ones. And I think we wound up paying about maybe it was about 5,700 for the unit. So got a pretty good deal there. And you mentioned those tax increases. Every time those properties change hands, the counties will recalculate. So you need to prepare for those, in your underwritings.
Yeah.
But yeah, like you said, treat contingencies.
And here is the part that most tech investors get excited about, which is the tax benefits, right? So there are some tax strategies in real estate like the cost segregation study, which lets you to speed up depreciation on your renovations, and it helps to reduce your W-2 taxable income.
Yeah, absolutely. Pramod, you can think about that kind of like cashing for taxes. You're taking your deductions up front for fast results. And then, I do recommend you work with a CPA who really does understand those real estate tax strategies. I'm not an expert, Pramod, you're not an expert, but I have benefited from depreciation, bonus depreciation.
Yeah. And what's interesting is this is how the wealthy play the game, not by evading taxes, but by leveraging incentives that reward investment and improvement.
So, hey, why don't we talk about where we actually could find these value add deals for a minute? Folks might wonder, where do these deals even live? I recommend looking for growing markets, the Sunbelt states, Midwest, the secondary metros behind the larger metropolitan areas where rents tend to kind of lag behind what the big cities doing.
Yes, Wally. And apart from that, you should also follow where the job growth is, where the population growth is, and where infrastructure is developing, right? It's like reading system telemetry. The data tells you where performance is trending up.
Yeah, absolutely. And it's always good to remember to look for these gems in your own backyard. A 1980s building with outdated rents can definitely outperform new construction when you optimize it correctly.
Right. So, Wally, now let's see how to get started. So, if you are new, I would say, in my opinion, start simple. Join a real estate meetup, attend webinars, and network with experienced operators.
Yeah, I cannot emphasize less how important that really is. Join the local real estate investors association, meetups, even conferences. I met you back in when was that, February, March here in
Yeah.
Phoenix at the Capital
Yes.
Raisers. conference. Great places to go meet and just network other operators who already have some experience. Another great way to do it is to invest passively in your first deal. Watch how the sponsors execute the value add plan, see how they report, see how they use their budgets, how the renovations go. Really, it's like getting that free MBA in multifamily investing.
Yeah, exactly. Like what you mentioned, getting free MBA in multifamily investing. Yeah. And if you want to be hands on later, that knowledge becomes your foundation for leading your own deals, right? Yeah. So now let's look at the 5 step framework, which is similar to the software lifecycle development in our world, right? So the first step is to discover, meaning to identify the inefficiencies in the property. The second step is to design or plan renovations and financial structure. And the third step is to develop or execute improvements with tight oversight to keep it under the budget. And the fourth step is to deploy, re-tenant, and optimize operations. And fifth is monitor the KPIs and adjust for maximum performance.
Yeah, I love those similarities between software development and just running a successful multifamily syndication. Same mindset we use in IT: build, iterate, optimize, repeat. And that's how you scale up success. Let's just kind of go over some key takeaways from what we've talked about today. Rapid fire recap for our listeners. Value add equals forced appreciation through better operations. It's that simple. Even small rent increases can create huge equity growth. Conservative underwriting is your best protection. And for tech pros, you already have the skills to analyze and track and optimize.
Yeah, this is, isn't it very similar to way how we do in our data engineering world, right? You can literally use the same logic you use in coding and apply it to the wealth building in real estate. It's about making data-driven decisions in the end and executing with discipline.
Absolutely, Pramod. I couldn't agree more. Just want to have our listeners remember that real wealth, it's not found, it's created in this multifamily space.
Yeah, Wally. And as we have alluded earlier also, you don't need perfect timing. It's just perfect execution with the right mindset.
All right. So if this episode helped you and you think differently about investing, hit the subscribe button and share it with your friends who still are kind of stuck to bugging their paychecks.
And connect with us on LinkedIn. We share real world deal breakdowns, market insights, and tools you can use to engineer your own financial freedom.
That's right. From tech stacks to apartment stacks, we've got you covered.
Love that. Remember, you can't automate wealth, but you can absolutely engineer it.